This is Jeremy Hutzel, CEO of Seven Springs Wealth Group. I'm joined by our Chief Investment Officer, Andy Michael. And I've been having some client conversations over the last week, Andy. Markets are at all-time highs. Clients see that in the news. At the same time, we're aware the economy is slowing down. As a matter of fact, the big news coming out last week was the Federal Reserve cutting interest rates by a quarter of a point for the first time in 9 months, a clear recognition of a slowing economy and some concern on their part about softness in the labor market. And what clients are asking me about and trying to reconcile is explain what's going on here. We've got an economy that's slowing down and yet a market that's at all-time high. What gives?
Yeah, it's a great question. I think it's one of the bigger ones on the market's attention right now. And simply put, the way I think about it is the stock market's drivers are not the same drivers that are driving the underlying economy. Let me just give you a simple example of a story that can kind of explain that. So if you think of NVIDIA, the world's largest stock at over $4 trillion, that one stock is larger than the entire Russell 2000, the 2,000 smaller publicly traded US stocks. And yet, NVIDIA employs 36 or so thousand people. The companies that make up the Russell 2000 employ 10 to 15 million people. And yet, NVIDIA drives the market at a greater degree and is larger than those 2,000 companies. So then the question becomes, well, what is driving the stock market? If it's not the economy that's completely driving the stock market, then what is driving the stock market? And right now, I do think the AI investment story is a large driver in the stock market. We just saw it with Oracle very recently when they came out and announced nearly $500 million in revenue performance obligations, contractual revenue over the next 5 years. And so we're seeing that AI build out, the AI infrastructure be a huge component into what's driving some of the larger sizes of the market. And then some of the smaller companies, smaller businesses, industrial companies, manufacturing companies, healthcare companies, they are seeing some of those economic pressures that the Fed is talking about, but you're not feeling the same effects because they're not the multi-trillion-dollar companies in the market.
It's interesting because over the years we've talked with clients, there's definitely a long-term correlation between economic growth and stock market health. Do you see this reconciling at some point in the future, or how are investors to be best prepared given this divergent path that we're on?
Yeah, I think that's a good question. So I would really be focused right now, again, on for businesses, where is their profit growth coming from? How are they thinking about investment over the next 5 to 10 years? Where are their margins coming from? Are their margins increasing or decreasing? One of the interesting things that we've seen over the past several years is companies don't necessarily just need another transaction sold. They might need you as a consumer or you as a business to sign up one time for their services, and then all of a sudden you become a recurring revenue stream. That is a much more defensible business model than the models of even 20 or 30 years ago, when I needed you constantly to be a transaction every single time. Transaction. So that's another one of those divergences that we're starting to see in the economy compared to the stock market. And one of the reasons why I think you can see these businesses continue to grow revenues, have recurring revenues, defensible revenues, even if you're starting to see some of that underlying softness in the economy as we're looking at.
Well, of course, I'll add to that the old adage that we've used over and over again: diversification is key. Perhaps a good place to close is recognizing with the story that you gave right at the beginning around the Russell 2000, just this past week, it hit all-time highs. So to your point, the market breadth of this rally is actually expanding.
It is, and I do think we're starting to see some of those effects of not only the Federal Reserve rate cuts, but the expectation that there may be some more cuts to come could start to stimulate some of those underlying softness that we've seen in the labor force recently. So we'll be certainly watching that as we look out ahead.
Great. Well, thank you for the time today. If you're out there listening and would like to expand upon this conversation in more depth with Andy or myself, please feel free to reach out.